risk management framework is more than just setting up a risk management function. It's about equipping the people with the culture, the governance, the processes, the tools and technology in order to do their work in the face of changes and uncertainty. Right? So the first thing that a resilient organization needs to establish is transparency and controls. I think a lot of time we are caught by surprise because we do not know what we do not know. And a lot of times what we do not know actually resides in our own organization. We do not know that our organization doesn't have something. Or we do not know that we are exposed to a certain area of the economy or the industry because there's a lack of transparency. All right? And there's also a lack of understanding of the controls or risk mitigation that we currently have in a particular area. So establishing transparency and control, right, through a proper governance process, through a proper, through a proper risk reporting process is very important because it will allow the organization to build up a risk-bearing capability and capacity to withstand a number of anticipated shocks. For example, fraud, shocks to the supply chain, hurricane, right, power failure, whatever it is. Those are not anticipated. As long as at least you have that capacity, you will be able to survive. And in order to have that capacity, I think firstly you need to understand, right, what are the risks that you are exposed to. Okay, you need to identify them. You also need to link it to your business strategies and initiatives. My colleague, Louis, will talk about our enterprise value map later, and that is a linkage to the value that your organization is trying to bring to the organization as well as the strategies. From the risk side of the, of the game, what we are trying to do is to say that if there are certain changes in the industry, certain changes in our organization, certain changes in our, in our people, right? How does that affect, right, our strategy? And we need to understand that very clearly because obviously only those factors which affect our crucial strategies are important to us. Those that are probably more operational in nature, right, may not be that important. One of the things that I like to remind you about is that when we start off with risks, identifying risks, we are all very enthusiastic. Our Deloitte risk database got 600 risk factors, right? And I can assure you, nobody can manage 600 risk factors. All right. So what we really need to do is to have very clear understanding of risk so that we can filter to the top 10 or 15, right? That is important for the senior management to think about, to focus on every quarter, right? And you need to do a triage. You can't just say for the sake of being safe, let's grab as much risk factors as we identify and go through them systematically. It doesn't work. Because remember, one of the limitations of human thinking is that we can only think about 3 to 4 things at a time. I think some researchers say that we can only handle 7 things at a time. More than 7, we probably get confused, right? So it's the same with risk. One of my clients make a conscious decision that they only look at top 10. Anything outside top 10 is outside the attention of the senior management. It gets managed at the middle level, but it's not managed at the senior management level. And because they know this top 10 is so important, it forces them to, to make sure that, right, these risks are really, really understood and then managed out of the business. They make sure that, they drive the understanding of this risk through the business because they are top 10 risks. These are the things that really can bring them down, right? And they build their risk information to highlight all these key risks to them. Because then when management has visibility into the key risks that affects the operation, then they obviously being intelligent people, they are able to manage it better, right? So the first thing to do is to identify risks, and there are various ways to identify risks. We have our enterprise value map, which will be talked about later. In Deloitte, we also have a risk intelligence map, but most people will start off with a checklist of risks, which could be, in this case, the market risk, technology risk, and organization risk. You may come up with your own checklist of risks, but it doesn't matter what checklist that you use. All right, just make sure that you start off with some generic checklist that you can then build upon to customize it for your organization. right? Once you identify risks, right, or groups of risks, then you need to make sure, you need to understand the relationship between risks. And that, I think, is one of the most neglected areas of risk assessment and identification. People usually like to identify a certain risk, then straight away go and assess the likelihood of the risk and the probability of the risk, right? And I call that lazy thinking, because how can you assess a probability of a risk and the impact of the risk without really understanding the interrelationship between the risk, the factors which are driving the risk in your organization, right? Looking at the environment that will nurture or cultivate some of these risks in your organization. So the understanding of risk is one of the most important part that you need to do, and that requires deep understanding of the business and deep analytical skills. Right? So the understanding of risk, you need to look at what are your value drivers. How does those risks affect the key value drivers? How are you competing in your market? Are you competing on price? So any factor which affects the pricing of your product may be a key risk factor. If you are competing in terms of your people's talent, like what we do in Deloitte, right? Then anything that affects our recruitment, anything that affects our career development, anything that affects the training of our people would be key risk factors for us, because the way we sell our services is that we say that we provide quality services to our client. And every time that promise is broken, it will damage our brand. It will, over the long run, erode our brand equity. And it's a key risk to us. Therefore, it's something that we cannot let it happen to Deloitte, right? So understanding where we compete, we are able to understand, where are the key risk factors, and understand how those key risk factors affect our business model. So we need to focus on risk sourcing, right? We need to focus on why risk happen, where it happened, and how can it happen. That is a very, very important part of risk management, right? So when you source for risk, some of the sources of risk could be changes in environmental condition, anomalies and deficiencies in business processes, errors, breakdown in information. So these are some of the sources, common sources of risk that you can look at, and based on these common sources of risk, then you can link it back to the risks that are present in your organization. Right. And after you understand the risk and you understand the impact, what you can do, and you can do this with an Excel spreadsheet, is to identify, right, what are the causes of the risk, the effect of the risk, how does that affect your existing assets of future growth, right? We have built a tool to do this, but I say you can actually do it, can somebody help me with going back to this slide? Slide number 23. Yeah. This is the wonders of technology. Yeah. This is the technology risk factor. Go up. Okay, this is the one. At the strategic level, right, I think all of us would like to know, well, if a typhoon happens and hit us, right, will our growth be impacted? How does that affect our balance sheet? How does that affect our P&L? How does that translate into numbers? All right. For certain risks, we can do it. For example, what we can do is that we can look at what are the risk drivers, whether they are internal, they are external risk drivers, right? And because we have done the phase of understanding risk, right, we can understand what's the impact of risk in terms of our market size, market share, our variable costs or our fixed costs, right? Then we can try to estimate a financial impact in terms of our sales, cost of goods sold, R&D, or the other things that goes into the income statement. And then hopefully we can then look at the impact in terms of our free cash flow or operating margins. Right? We have done that quite successfully for a number of clients who really want to understand, for example, at a strategic level, if certain disruptive forces were to, be unleashed upon their organization, what will that happen? I'm not saying it can be done for all risks, but some of the important strategic risks could really benefit from this treatment, because even though the numbers are quite rough and they are not exactly that accurate, right? But, you know, it gives directionally a sense of the size of the risk that you are exposed to, and therefore give management a sense of what they should spend, or what in terms of effort, in terms of money, in terms of time, right, in order to manage those risks. Oh, okay. Okay. Does that work? Yeah, and I'm not equipped to manage this risk. I don't have a risk management framework to manage this. Okay, I'll go on to the manual risk management. My automated control doesn't work, so I've got to go for manual control now. Okay, can I? Right. Tell you what, I'll take that mic. Hello? Yeah, okay. Oh, can use the mouse, yeah. Okay. Can you go back up, Richard? Just get back, go back. Okay, go back up to the risk management framework slide. Okay, right. So that is the process about, thinking about risk and how do you do the risk identification, understanding, and analyzing the impact of risk. But in terms of an organization structure, right, what do you need in your organization in order to do all those steps I'm thinking about, I've talked about, which is firstly, risk identification, understanding, assessment, and impact analysis, right? So what you need is to make sure the following elements in place. You need to have leadership, obviously, right? If you don't have a commitment from your senior leadership in terms of doing risk management, it really doesn't work, because risk management is not very sexy. It's not like strategic planning. You get all excited about the future. Everybody jumps in and say we could be a Fortune 500 company in 3 years, right? And let's all charge for it, right? Risk is always quite boring, right? It's sometimes quite distressing, because you talk about some of the things that are uncertain, right? Correct? And they are disruptive, and nobody likes to talk about it. And also, there's no really common language to talk about risk. Whenever we talk about risk, you may get bogged down in very operational details. Somebody will say, well, if you enter this thing into the computer system, there's an error, it will impact this and this. But that's really operational. That's really, well, if we make one mistake, so what's the impact? Very minor, right? So the language in which you talk about risk is also, when you start off, like I say, most people start with the operational side, which is not very sexy, right? And then the other thing is that you need to make sure that there are risk management policies that are communicated clearly, right? And you don't need to start off with a very, very sophisticated risk management policy. You just need to go to the internet, please copy some risk management policy there, right? Amend it a little bit here and there. It's always, there are some, I don't know, I don't have to teach you where to find it, right? Yeah. But the important thing is, why is a risk management policy important? Because it sets the approved framework, right? What is the framework in which risk is to be identified and managed, right? It sets the tone about the culture, that risk management is important to the organization. Senior management, right, wants it to be done properly, and that there are processes in place which are mandated by the organization that needs to be followed in order to manage